Hey, Steve Saretsky here. As always, this is Canadian real estate market update with a particular focus on Vancouver. If you get any sort of value or entertainment out of these videos, all I ask that you hit thumbs up and subscribe. Questions, comments, put those below. I want to touch this week a little bit on central banking, central bank policy, as well as Canada and US home prices, and a little bit of the June housing numbers in Vancouver. So I know that central banking might turn a few people off, but I'll try to keep this as lively, simple, and entertaining as possible. One thing that always intrigues me is when you read articles, generally speaking, about housing and the housing crisis, the housing crunch, and the unaffordability. You never ever hear discussions about central bank policy. It's always, people are always complaining about zoning, and it's because we haven't rezoned properties. That's why we have house prices have basically doubled over the last 3 or 4 years. Or the discussion simply goes to, China, we had all this Chinese money, but nobody ever talks about how that money is actually created. That actually facilitates all this increase in home prices. So you have to remember that banks create credit, and credit is what people use to basically pay for this house. And what I guess in the most simplistic ways that I can explain it is banks can create credit faster than developers can build new homes. So as long as there's credit easily and readily available, and that people actually want to physically borrow the credit, house prices will continue to grow because developers cannot outpace the growth of credit. So it's actually important to follow the credit, and that's really just following what central banks are doing. So it should be no surprise that we're in this sort of Goldilocks era of the economy where we've been in this 10-year expansion. And literally every single asset class is pretty much at peak valuation. So whether you're running a private equity firm, whether you're looking at the equity market, whether you're looking at real estate, whether you're looking at any sort of asset class, they're all sort of frothy and at peaks. And so you have to sort of scratch your head and say, well, why is this? And really it is just this central bank exuberance, this easy money credit. Even the money that came out of China, that's all facilitated through monetary policy and the banks, basically, central banks creating this environment for excess credit creation, which again is the real rise that we've seen. Is basically all this credit creation has flown into assets, and none of it has actually flown into into productivity in the economy. So what we see is this sort of low growth, sort of sub 2%, maybe you get to 2%, you're trying to hit a 2% inflation target. It's a very, very low growth environment, yet just absolutely astronomical asset valuations. That is because all this credit creation has created this speculation and put into assets, and central banks are in a position now where they've sort of blown this asset bubble across all assets that you can't really raise interest rates, and you have to sort of keep this thing going because it's so large. And so where am I going with this is basically I had a couple conversations this past week. One was with a very large investment advisor, and the other one was with the economist / main finance analytical person at one of the, I would say, fairly large Canadian banks, not one of the big six, but just outside of that. So I'm not going to mention any names for obvious reasons. But we kind of came to this conclusion, and one thing I see here in the YouTube comments is that although these videos might come off as bearish or negative or whatever the case is that generally speaking, when you understand what is kind of happening with monetary policy, i.e. negative interest rates, excessive quantitative easing, which is basically buying up assets with essentially printed money, it's kind of this fictitious Ponzi scheme. And so that's where a lot of the criticism comes. But you get these people that are saying, okay, well, Vancouver is so unaffordable, it is so expensive, and there's no way that this crack shack in, say, Surrey should cost you $1.1 million. Like, the real tangible value of that should be somewhere like closer to affordable levels where the incomes match sort of that asset price, which is maybe, you could argue 500,000, 600,000. And so that's a lot of the comments I'm hearing people saying, oh, home prices are going to fall, 88%, or, they're going to go fall back to this 2004 level when the prices were actually affordable. But the problem is just because that's what logically would make sense doesn't mean that's going to happen. So, and I see this a lot, it's just like, even myself maybe sometimes is guilty, that just because that they've created this Ponzi, and just because it would make logical sense that this Ponzi should, or I want this Ponzi to unwind, or whatever the case is, that it should go back to this level where it actually would make sense again. But unfortunately, that's just not the reality of the situation is, right? Like, the reality is central banks are continuing to manipulate the currency. Now we're talking about the Fed should be cutting rates. Sort of some smart people that I have a lot of respect for, market commentators, calling that the next Fed meeting in July is going to be a 50 basis point rate cut. That's what they believe. I'm not saying that's going to happen. There might not be any cut in July, but basically the people are saying, hey, listen, we need to cut 50 points. The Fed should cut 50 points. Just the fact that they're talking about a Fed cut when the equity market is at all-time highs, the unemployment rate in the U.S. is at like record lows, is at 3.6%, and we're talking about a 50 basis point cut in rates. To me, is just mind-boggling. And again, I'm running this by like through all the context that I have in the economic space. It's just like the data. Does the data truly warrant that, or are they just getting ahead and saying we can't let this thing die? We need to keep it propelled and going. And so I think basically to summarize is that even though you might have this hypothetical level, central banks are always finding creative ways to keep things afloat. And so all you have to do is go and look at, I think it was Austria, they're doing 97-year bonds, and it was oversubscribed, the amount of interest for these 100-year bonds yielding basically 1.7% or something, or actually 1.1%. In parts of Europe, right, you have, across the world, we have $13 trillion in negative yielding debt. So basically it means you buy a bond and they promise to pay you a lower value in the future. Just that fact alone should make you scratch your head and just say, that's how crazy and out of whack things can get. So kind of what will they drum up next, right? So now, of course, we're talking about modern monetary theory, et cetera, et cetera, et cetera, which, again, if you don't know what modern monetary theory is, just Google it. Plenty of information out there. But this is basically where we are today. And so I always look at it, I'm like, okay, well, let's compare logically to Canada and the US. So, Better Dwelling put out a thing the other week showing the price difference in Vancouver, the growth in home prices and real estate in Vancouver versus New York, San Francisco, Los Angeles, etc. And the price growth is off the chart. Just take a look for yourself. But you could apply this exact same chart to Toronto, to Montreal. In fact, let's look at the Canadian real estate, the 11-city Terranet Index versus the Case-Shiller 20-city U.S. home price index. And you can see there's been a complete divergence after 2008 when the U.S. home prices corrected, and Canada's continue to grow unabated. So my conversation with these two individuals this week was, logically it makes sense. You just look at those two charts that I just showed you. Logically it makes sense that home prices should and need to correct, and they probably need to correct significantly. But he's like, logically, and we both agreed to this, like logically, like what if there's just like that one thing that the central banks just somehow pull out that nobody sees coming, and one of those is like, well, like what if they just created this 100-year bond, or they just start rapidly buying Canada mortgage bonds en masse. And again, it's funny because I talked about last week's video that the infallible central bank, that they wouldn't be able to keep, they can't keep recessions from not happening. They can't necessarily keep markets elevated to the full extent, but they can certainly ease enough where it stops a correction that should be more prolonged or more significant to the downside. And so I guess that was one thing that, again, I took away from these people. And it's funny because the bank economist actually said to me, Steve, we wrote a report in 2017 and we circulated around the bank, and it's my job to advise this firm, this Canada-wide firm, this publicly traded firm, to the best of my ability. And he says in 2017 we wrote a piece and we said the base case for Vancouver real estate is for prices to drop 20% minimum. And he says we are estimating between 20 to 40% correction in Vancouver real estate prices. Again, this is not the big five, but just outside of that. That was his case and his thesis. And we're sitting there talking about, again, central banks, monetary policy. And he says, and the only thing that is potentially stopping that is really just what central banks can or are potentially willing to do. And as I've said before, I mean, interest rates for the Bank of Canada are at 1.75%. There's really not a whole lot of room there, but they can create these magic bunnies out of their hat, it seems like. All you have to do is look at the Bank of Japan, which has basically been engaged in quantitative easing for the past 20 years, basically buying up all the JGBs, which is the Japanese government bonds out there. I mean, there's days where I think it's a 10-year Japanese bond. There's not a single bond traded, simply because they just don't trade. The central bank buys all the debt. So, you hope that you aren't going into that environment where this is like the world that we live in. It's kind of you're just these ploys to the central banks, and currencies become so manipulated. But that's really what it is. And it's funny because I actually heard somebody on YouTube, talking about real estate, and they said, by 2040, real estate prices will double in Vancouver. And I said, it's certainly possible, and I think it's actually realistic, because, and it won't be because they double necessarily in value. It'll be because there is such an erosion of the actual currency. What the central banks are they're basically debasing the value of the currency. When you have as much debt as you do, you have to continue to print more money and try to inflate away those debts so they become less burdensome to pay, right? So if you have a deflationary environment, i.e. the value of your currency is actually increasing as prices are going down, that becomes harder to then service debt. So that's why if prices were to double in 2040, which if they don't, you'll probably have more problems than anything, because you'll probably is telling me that you're in a deflationary environment. That's actually a problem. So anyways, that's pretty much all I have for this week. Quick little tidbit. Next week we'll be talking about Vancouver real estate summary sales figures for June, the month of June. I can tell you preliminarily that you can take this to the bank right now is Greater Vancouver real estate home sales across all property types did and will and have come in at a 19-year low for the month of June. So again, it was the slowest month for home sales activity in Greater Vancouver since the year 2000. That's all I'll say for now. So the sort of hype that everybody got excited about, because we had sort of this what looked like a seasonal uptick in May, which is kind of typical, seems to have faded in June. Again, I think the 19-year low in sales volumes kind of just speaks for itself. I don't really have to say anything other than that. But we'll get more into that next week. So anyways, just to summarize, those are my thoughts. Again, when we're looking at this, I'm looking at just the things that necessarily you think should happen don't necessarily always happen. And just because morally it seems right or logical that they should come down to this sort of quote unquote affordable level to match the incomes, unfortunately there's just such manipulation in financial markets, and in the actual currency itself, and in government, etc., that just because it's logically makes sense doesn't mean necessarily that it will happen. And I think that was, my conversation was that these guys were basically telling me that, like, we actually agree with you. And, like, the guy's like, hey, listen, I actually have a 20 to 40% price decline that I've publicly given out to all the members in the bank. But he says the only thing that would probably impact that is really just the manipulation. This is like, how far are they willing to take it, right? So anyways, that's all I got for this week. Hope that video helped. Otherwise, see you next week.